Chapter 3. The Philosophy Matures. Our entry into World War II was not entirely without some significance in the development of my investment philosophy. Early in 1942, I found myself in an unaccustomed role as a ground officer doing various business-related jobs for the Army Air Corps. For 3.5 years, I simply beached my business as I performed my not very valuable services on behalf of Uncle Sam. In recent years, I have frequently said that I did quite a job for my country. Neither Hitler nor Emperor Hirohito ever succeeded in getting a man into the territories I defended. These were Arkansas, Texas, Kansas, and Nebraska. At any rate, during this time of various desk-type jobs wearing Uncle Sam's uniform, I found that almost without warning I would alternate between two different types of periods. For a while, I would have so much to do that the last thing I would be able to think about was my peacetime business. At other times, I would sit at my desk with very little to do. When things were slow, I found it less unpleasant to analyze in great detail just how I would build up my business when the happy day that I would no longer be wearing a uniform might arise than it was to think of the personal living and army-type problems with which, from a short-range point of view, I was confronted. It was during such periods that my present investment philosophy took steadily more definite shape. It was then I decided there was not enough future in the type of in and out trading that I have described in the stock of California packing. During this period, I reached two other conclusions that were to be of some significance to my future business. Before the war, I had served all types of clients, large and small, with varying types of objectives. Most, but not all, of my business had been focused on finding unusual companies that would enjoy significant, above-average growth in future years. After the war, I would limit my clientele to a small group of large investors with the objective of concentrating solely on this single class of growth investment. For tax reasons, growth was more likely to benefit these clients. My other major conclusion was that the chemical industry would enjoy a period of major growth in the post-war years. Therefore, a high-priority project on returning to civilian life was to endeavor to find the most attractive of the larger chemical companies and make this a major holding for the funds I was handling. I by no means spent 100% of my time doing this, but in the first year after restarting my business, I did spend a rather considerable amount of time in talking to anyone I could find who had real knowledge of this complex industry. Such people as distributors who handled the lines of one or more large companies, professors in the chemical departments of the universities who had intimate knowledge of chemical business people, and even some of those in the major construction companies that had put up plants for various of the chemical producers all proved extremely worthwhile sources of background information. By combining these inputs with analyses of the usual financial data, it only took about 3 months to narrow the choices down to one of 3 companies. From there on, the going was slower and the decisions more difficult. However, by the spring of 1947, I decided that the Dow Chemical Company would be my choice. E pluribus unum. There were many reasons for the choice of Dow Chemical from the many promising chemical firms. I believe it might be worthwhile to enumerate some of them because they are clear examples of the type of things I seek in the relatively small number of companies in which I desire to place funds. As I began to know various people in the Dow organization, I found that the growth that had already occurred was in turn creating a very real sense of excitement at many levels of management. The belief that even greater growth lay ahead permeated the organization. One of my favorite questions in talking to any top business executive for the first time is what he considers to be the most important long-range problem facing his company. When I asked this of the president of Dow, I was tremendously impressed with his answer. It is to resist the strong pressures to become a more military-like organization as we grow very much larger, and to maintain the informal relationship whereby people at quite different levels and in various departments continue to communicate with each other in a completely unstructured way and, at the same time, not create administrative chaos. I found myself in complete agreement with certain other basic company policies. Dow limited its involvement to those chemical product lines where it either was or had a reasonable chance of becoming the most efficient producer in the field as the result of greater volume, better chemical engineering and deeper understanding of the product, or for some other reason. Dow was deeply aware of the need for creative research not just to be in front, but also to stay in front. There was also a strong appreciation of the people factor at Dow. There was in particular a sense of need to identify people of unusual ability early, to indoctrinate them into policies and procedures unique to Dow, and to make real efforts to see if seemingly bright people were not doing well at one job, they be given a reasonable chance to try something else that might be more suitable to their characteristics. I found that although Dow's founder, Dr. Herbert Dow, had died some 17 years before, his beliefs were held in such respect that one or another of his sayings was frequently quoted to me. While his comments were directed primarily at matters within Dow, I decided that at least two of them were equally appropriate to my own business, in that they could be applied at least as well as to optimizing the selection of investments as to matters internal to the Dow Chemical Company. One of these was never promote someone who hasn't made some bad mistakes, because if you do, you are promoting someone who has never done anything. The failure to understand this element by so many in the investment community has time and again created unusual investment opportunities in the stock market. The truly worthwhile accomplishment in the business world nearly always requires a considerable degree of pioneering, in which ingenuity has to be seasoned with practicality. This is particularly true when the gains are sought through leading-edge technological research. No matter how able the people are and no matter how good may be most of their ideas, there are times when such efforts are bound to fail, and fail dismally. When this happens and the current year's earnings drop sharply below previous estimates as the costs of the failure are added up, time and again the investment community's immediate consensus is to downgrade the quality of the management. As a result, the immediate year's lower earnings produce a lower than the historic price-earnings ratio to magnify the effect of reduced earnings. The shares often reach truly bargain prices. Yet if this is the same management that in other years has been so successful, the chances are the same ratio of average success to average failure will continue on in the future. For this reason, the shares of companies run by abnormally capable people can be tremendous bargains at the time one particular bad mistake comes to light. In contrast, the company that doesn't pioneer, doesn't take chances, and merely goes along with the crowd is liable to prove a rather mediocre investment in this highly competitive age. The other of Dr. Dow's comments which I have tried to apply to the process of investment selection is, if you can't do a thing better than others are doing it, don't do it at all. In this day of heavy-handed government intervention in so many types of business activities, of high taxes and labor unions, and of rapid shifts in public taste from one product to another, it seems to me that the risk of common stock ownership is seldom warranted unless it is confined to companies with enough competitive spirit constantly to be trying and frequently succeeding in doing things in a manner superior to industry in general. In no other way are profit margins usually broad enough to meet the demands of growth. This is, of course, particularly true during periods when inflation is having a significant effect in eating away at reported profits. History versus opportunity. There were some remarkable parallels between the period when I was starting my business at the depths of the Great Depression and during the years 1947 through the very early 1950s, when I was restarting it after a military service interlude of 3.5 years. Both periods were times when it was unusually hard to obtain immediate results for clients in the face of overwhelming general pessimism. Both were times that were to prove spectacularly rewarding for those who had the patience. In the earlier period, stocks were driven to perhaps the lowest level in relation to real value seen in the 20th century, not just because of the economic havoc wrought by the Great Depression, but also because prices were discounting the worry of many investors as to whether the American system of private enterprise would itself survive. It survived, and in the ensuing years the rewards of those able and willing to invest in the right stocks were fabulous. Just a few years after World War II, another fear kept stocks at levels almost as low in relation to intrinsic value as those seen at the depths of the Great Depression. This time, business was good and corporate earnings were steadily rising. Nevertheless, almost the entire investment community were mesmerized by a simple comparison. A relatively few years after the Civil War, a period of immediate prosperity was followed by the Panic of 1873 and almost 6 years of deep depression. A somewhat similar period of prosperity after World War I was followed by the crash of 1929 and the even deeper depression of about the same length. In World War II, the costs of war had run on a per diem basis about 10 times that of World War I. Therefore, reasoned the dominant investment view of this period, current excellent earnings don't mean anything. They will be followed by a horrendous crash and a period of extreme adversity when all would suffer. Year after year went by and the per-share earnings of more corporations rose. Along about 1949, this period became known as the era in which American business is worth more dead than alive, because as soon as word spread that a publicly owned company was about to go out of business, its shares would rise dramatically. The liquidating value of many a company was so much more than its current market valuation. Year followed year, and slowly it began dawning on the investment public that perhaps stocks were being held back because of a myth. The expected business decline never did arrive and, excepting for two relatively minor recessions in the 1950s, the stage was being set for the great rewards to long-term investors that were to follow. As I write these words in the closing weeks before the decade of the 80s is about to start, it amazes me that more attention has not been paid to restudying the few years of stock market history that started in the second half of 1946 to see whether true parallels may actually exist between that period and the present. Now, for the third time in my lifetime, many stocks are again at prices which, by historic standards, are spectacularly low. In relation to reported book value, they may not be quite as cheap as they were in the post-World War II period. However, if that reported book value is adjusted for replacement value in real dollars, they may perhaps be cheaper than in either of the two prior bargain value periods. The question arises: are the worries that are holding back stock values in the present period such matters as the high cost of energy or the dangers from the political left or of overextended credit, with the inevitable resulting drain on the level of business activity as liquidity is restored, more serious and more apt to stop the future growth in this country than the fears that held back stock prices in these two prior periods? If not, once the problems of overextended credit have been solved, it might be logical to assume that the 1980s and period beyond may offer the same sort of rewarding opportunities that characterized the two former periods of abnormally low prices. Lessons from the vintage years. From a business standpoint, the 15 years from 1954 through 1969 were a magnificent time for me, as most of the relatively few stocks I was holding advanced significantly more than did the market as a whole. Even so, I managed to make some bad mistakes. Successes came from diligent application of the approaches I have already spelled out. It is the mistakes that are more noteworthy. Each brought its own new lesson. Good fortune can breed laxness. The mistake which now embarrassed me the most, although it was not the most costly, arose from the careless application of a sound principle. In the early 1960s, I had technological investments that were proving quite pleasing in the electronic, chemical, metallurgical, and machinery industries. I did not have a comparable investment in the promising drug field and started seeking one. Along the way, I talked to a medical specialist who was preeminent in his field. At the time, he was tremendously excited about a new drug family about to be introduced by a small Midwestern manufacturer. These drugs he felt could have quite favorable impact on the future earnings of this firm relative to others in this field. The potential market seemed very, very exciting. I then talked to just one of the officers of this company and to only a few other investment people, all of whom were equally excited about the potentials of this new drug. Unfortunately, I did not pursue my standard checks either with other drug companies or with other experts knowledgeable in this particular specialty to see if they might have contrary evidence to offer. Regretfully, I subsequently learned none of the proponents had made a thorough investigation either. The stock was selling at a price well above its worth before considering the benefits of this new family of drugs, but at a price which could have been but a minor fraction of potential value if the new drugs were all their supporters imagined. I bought the shares only to see them drop at first a mere 20% and then over 50%. Ultimately, the whole company was sold for cash at this low price to a large pharmaceutical corporation seeking to enter the drug field. Even at this price, now somewhat less than half of what I had paid for the shares, I subsequently learned that the acquiring company lost money on the deal. Not only did this new family of drugs fail to measure up to the extensive hopes that had been enthusiastically projected by my friend, the medical specialist, but also on painful post-mortem re-examination of the situation, I found that there were management problems in this small drug manufacturer. With a more thorough investigation, both failings would, I believe, have become apparent to me. From that embarrassing time forward, I have tried to be particularly thorough in making investigations in periods when things were going well. The only reason this particular investment folly wasn't more costly stemmed from my caution. Since I had had only a slight contact with the management, I made only a small initial investment, planning to buy more as I got to know the company better. Their troubles overtook me before I had a chance to compound my original folly. As the long bull market was reaching its final peak in 1969, another mistake occurred. To understand what happened, it is necessary to recreate the psychological fever which gripped most investors in technological and scientific stocks at that time. Shares of these companies, particularly many of the smaller ones, had enjoyed advances far greater than the market as a whole. During 1968 and 1969, only one's imagination seemed to cap the dreams of imminent success for many of these companies. Some of these situations did have genuine potential, of course. Discrimination was at a low ebb. For example, any company serving the computer industry in any way promised a future many believed that was almost limitless. This contagion spread into instrument and other scientific companies as well. Up to this time, I resisted the temptation to go into any of the similar companies that had just gone public at very high prices in the previous year or two. Yet, being in frequent contact with those who were sponsoring these excitement-inducing companies, I kept looking for a few that might be genuinely attractive. In 1969, I did find an equipment company working in an extremely interesting new frontier of technology, one that had a real basis for its existence. The firm was run by a brilliant and honest president. I can remember still, after a long luncheon session with this man, my pacing up and down the airport awaiting my airplane home and trying to determine whether I should buy this company's shares at the prevailing market. After considerable deliberation, I decided to go ahead. I was right in diagnosing the potential of this company, for it did grow in the years that followed. Nevertheless, it was a poor investment. My mistake lay in the price I paid to participate in the promise. Some years later, after the company had shown rather respectable growth, I sold these shares, but at a price very little different from my original cost. While I believe I was right in selling when I thought the company had reached a point where its future growth was considerably more uncertain, nevertheless, selling an investment at a meager profit after it has been held for a number of years is not the way to make capital grow or even protect it against inflation. In this case, disappointing performance was the result of being seduced by the excitement of the times into paying an unrealistic initiation price. Do few things well. A policy judgment that was wrong for me engendered quite a different kind of mistake, and one which did cost a significant amount of dollars. My mistake was to project my skill beyond the limits of experience. I began investing outside the industries which I believe I thoroughly understood, in completely different spheres of activity, situations where I did not have comparable background knowledge. When it comes to manufacturing companies that serve industrial markets or to companies on the leading edge of technology that are serving manufacturers, I believe that I know what to look for, where both the strong points and pitfalls may lie. However, different skills proved important in evaluating companies making and selling consumer-type products. When the products of competitive companies are essentially rather similar to one another, and when changes in market share depend largely on shifting public tastes or on fashions greatly influenced by the effectiveness of advertising, I learned that the abilities which I had in selecting outstanding technological companies did not extrapolate to the point where I could identify what produces unusual success in real estate operations. Others may do well in quite diverse investment arenas. Perhaps, unlike the other types of mistakes I have made during my business career, this one should properly be ignored by others. Nevertheless, an analyst must learn the limits of his or her competence and tend well the sheep at hand. Stay or sell in anticipation of possible market downturns. Should an investor sell a good stock in the face of a potentially bad market? On this subject, I fear I hold a minority view given the investment psychology prevalent today. Now more than ever, the actions of those who control the vast bulk of equity investments in this country appear to reflect the belief that when an investor has achieved a good profit in a stock and fears the stock might well go down, he should grab his profit and get out. My view is rather different. Even if the stock of a particular company seems at or near a temporary peak and that a sizable decline may strike in the near future, I will not sell the firm's shares provided I believe that its longer-term future is sufficiently attractive. When I estimate that the price of these shares will rise to a peak quite considerably higher than the current levels in a few years' time, I prefer to hold. My belief stems from some rather fundamental considerations about the nature of the investment process. Companies with truly unusual prospects for appreciation are quite hard to find, for there are not too many of them. However, for someone who understands and applies sound fundamentals, I believe that a truly outstanding company can be differentiated from a run-of-the-mill company with perhaps 90% precision. It is vastly more difficult to forecast what a particular stock is going to do in the next 6 months. Estimates of short-term performance start with economic estimates of the coming level of general business. Yet the forecasting record of seers predicting changes in the business cycle has generally been abysmal. They can seriously misjudge if and when recessions may occur and are worse in predicting their severity and duration. Furthermore, neither the stock market as a whole nor the course of any particular stock tends to move in close parallel with the business climate. Changes in mass psychology and in how the financial community as a whole decided to appraise the outlook either for business in general or for a particular stock can have overriding importance and can vary almost unpredictably. For these reasons, I believe that it is hard to be correct in forecasting the short-term movement of stocks more than 60% of the time, no matter how diligently the skill is cultivated. This may well be too optimistic an estimate. On the face of it, it doesn't make good sense to step out of a position where you have a 90% probability of being right because of an influence about which you might at best have a 60% chance of being right. Moreover, for those seeking major gains through long-term investments, the odds of winning are not the only consideration. If the investment is in a well-run company with sufficient financial strength, even the greatest bear market will not erase the value of holding. In contrast, time after time, truly unusual stocks have subsequent peaks many hundreds of % above their previous peaks. Thus, risk-reward considerations favor long-term investment. So, putting it in the simplest mathematical terms, both the odds and the risk-reward considerations favor holding. There is a much greater chance of being wrong in estimating adverse short-term changes for a good stock than in projecting its strong, long-term price appreciation potential. If you stay with the right stocks through even a major temporary market drop, you are at most going to be temporarily behind 40% of the former peak at the very worst point and will ultimately be ahead. Whereas if you sell and don't buy back, you will have missed long-term profits many times the short-term gains from having sold the stock in anticipation at a short-term reversal. It has been my observation that it is so difficult to time correctly the near-term price movements of an attractive stock that the profits made in the few instances when this stock is sold and subsequently replaced at significantly lower prices are dwarfed by the profits lost when timing is wrong. Many have sold too soon and have either never gotten back in or have postponed reinvestment too long to recapture the profits possible. The example I will use to illustrate this point is the weakest one I have experienced. In 1962, two of the major electronics investments I had made had risen to heights that made the outlook for near-term price movement extremely dangerous. Texas Instruments was selling at over 15 times the price I had paid for it 7 years before. Another company which I bought a year or so later, and which I shall call by the fictitious name of Central California Electronics, had enjoyed a similar percentage rise. Prices had gone too far. I consequently informed each of my clients that the prices of these two stocks were unrealistically high and discouraged them from using these prices in measuring their current net worth. This is a practice I have rarely followed, and then only when I had an unusually strong conviction that the next important move for one or more of my stocks would be sharply downward. Nevertheless, in the face of this conviction, I urged my clients to maintain their holdings in the belief that some years ahead both stocks would rise to very much higher levels. When the correction in values came for these two stocks, it proved even more severe than I had anticipated. Texas Instruments at its subsequent bottom sold off 80% from its 1962 peak. Central California Electronics did not perform quite so badly but still sold off by almost 60%. My beliefs were being tested in the extreme. However, within a few years Texas Instruments was once again selling at new high levels, more than double its 1962 high. Patience had paid off here. Central California Electronics' performance was not a happy one. As the general stock market started to recover, problems within the management of Central California Electronics became apparent. Changes in personnel occurred. I became quite worried and made what I believe was a thorough investigation. I reached two conclusions and neither one pleased me. One was that I had misjudged the former management. I should have been more aware of its deficiencies, yet wasn't. Neither could I be sufficiently enthusiastic about the new management to warrant continuing to hold the shares. I consequently sold these holdings in the following 12-month period at a price only slightly better than half of the 1962 peak. Even so, my clients, depending on the applicable purchase price, gained from 7 to 10 times the original cost. As I have already indicated, I am deliberately citing a weak example rather than a dramatic one to illustrate why I believe it pays to ignore near-term fluctuations in situations that hold real promise. My error in the Central California Electronics instance was not in holding the shares through a temporary decline, but in something far more important. I had grown too complacent as a result of the enormous success of my investments in this company. I began paying too much attention to what I was hearing from top management and not doing sufficient checking with people at lower levels and with customers. When I recognized the situation and acted upon it, I was then able to make the same kind of gains I had expected to make in Central California electronics by switching these funds to other electronic companies, chiefly Motorola, which fortunately rose in the next few years to a value several times higher than the prior peak of Central California electronics. In and out, maybe out of the money. There is more to learn from the Texas Instruments and Central California electronics situations. When I originally acquired these Texas Instruments shares in the summer of 1955, they were bought for the longest type of long-range investment. It seemed to me the company fully warranted this degree of confidence. About a year later, the stock had doubled. With one exception, the various owners of the funds I managed, familiar as they were with my method of operations, showed no more interest in taking a profit than did I. However, at that time I had one relatively new account owned by people who, in their own business, were used to building up inventory when markets were low and cutting it back sharply when they were high. Now that Texas Instruments had doubled, they brought strong pressure to sell, which for a time I was able to resist. When the stock rose an additional 25% to give them a profit of 125% of their cost, the pressure to sell became even stronger. They explained, "We agree with you. We like the company, but we can always buy it back at a better price on a decline." I finally compromised with them by persuading them to keep part of their holding and sell the rest. Yet when the big drop occurred several years later and the shares fell 80% from their peak, this new bottom was still almost 40% higher than the price at which this particular holder was so eager to sell. After a very sharp advance, a stock nearly always looks too high to the financially untrained. This client demonstrated another risk to those who follow the practice of selling shares that still have unusual growth prospects simply because they have realized a good gain and the stock appears temporarily overpriced. These investors seldom buy back at higher prices when they are wrong and lose further gains of dramatic proportions. At the risk of being repetitious, let me underscore my belief that the short-term price movements are so inherently tricky to predict that I do not believe it possible to play the in-and-out game and still make the enormous profits that have accrued again and again to the truly long-term holder of the right stocks. The long shadow of dividends. In these comments I have tried to show how, as the years have passed, various experiences gradually helped to shape my investment philosophy. However, looking back, I find no specific event, either a mistake or a favorable opportunity, which caused me to reach the conclusions I have on the matter of dividends. Many observations over a long period of years gradually crystallized my views. I started out taking for granted the belief, as widely accepted 40 years ago as it is today, that dividends were something highly favorable to the stockholder and something which should be welcomed enthusiastically. Then I began seeing companies that had so many exciting-looking new ideas flowing from their research departments that they could not capitalize upon them all. Resources were too scarce or too expensive. I began thinking how much better it might be for some stockholders if, instead of paying dividends, more of the company's resources were retained and invested in more of these innovative products. I began increasingly to recognize that the interests of all stockholders were not identical. Some investors needed dividend income to support their lifestyle. These stockholders would undoubtedly prefer current dividends to greater future profits and increased value for their shares resulting from increased investment in promising products and technologies. These investors could find investments in firms whose needs and opportunities for productive use of capital were not too demanding. But how about the stockholder whose earning power or other income sources exceeded needs and who was regularly saving money anyway? Would it not be better for this investor if the company passed up its dividends, which would often be subject to a fairly high income tax rate, and instead reinvested the funds, tax-free, in future growth? Shortly after World War II, when I started concentrating my investment activities almost solely on the attainment of major, long-range capital appreciation, another aspect of the dividend payout issue became even more apparent. The companies with the greatest growth prospects were under tremendous pressure to pay no dividends at all. Their need for funds and their ability to use funds productively was too large. The cost of developing these new products was just the first heavy drain on capital needed to finance growth. There followed the heavy marketing expense needed to introduce them to the customer. With success, plant expansion was needed to service a growing volume. Once the new line was on its way, there were further capital requirements for the increased inventories and accounts receivable which, in most cases, grow almost in direct proportion to the volume of the business. There seemed a natural fit of interest between those firms with bountiful investment opportunities and certain investors who sought to make the greatest possible profit in relation to the risk involved and who neither needed additional income nor wanted to pay unnecessary taxes. Such investors should, I believe, mainly confine investments to non-dividend paying companies with strong earning power and with attractive places to reinvest their earnings. These were the clients I sought to serve. Recently, however, the situation has become less clear-cut. Institutional holders have become an increasingly dominant force in day-to-day stock transactions. Institutions such as pension and profit-sharing funds pay no income tax on their dividends. Many of them, as a matter of policy, will not invest in a company unless it pays some dividend, no matter how small. Attracting and holding these buyers have caused many companies with unusual prospects to initiate modest dividend payments of rather small percentage total annual earnings. Managers of some would-be growth companies have concurrently reduced their payout dramatically. Today, the skill in investing retained earnings wisely has become a more critical factor in separating the unusual company from the pack. For these reasons, I have come to believe that the most that can be said on the subject of dividends is that it is an influence that should be downgraded very sharply by those who do not need the income. In general, more attractive opportunities will be found among stocks with a low dividend payout or none at all. However, so general is the feeling among those who determine dividend policies that paying out dividends is beneficial to the investor as it is for some, that occasionally I have found truly attractive opportunities among higher dividend payout companies, although this has not happened very often.